Hey, I'm John Stevenson. Welcome to the Guaranteed Retirement Guy Show. Today, we're going to be talking about the best alternative to risky investments for your retirement income. All right, so if you've seen any of my videos, you know that I love guaranteed income for life. And I love it because it allows me to be risky in other investments. Okay, I'm not against risk. I do a lot of risky things, and that doesn't, that's not to say that all risk is bad or all guarantees are bad. There's a place for both of them. So I have people reach out to me who are in risky investments and they want out, and they're like, all right, I want everything in safety. I want guarantees, and that's fine, but you don't have to do all of it. Like, you can still stay in risk and be able to provide guarantees in your retirement. And the best way, in my opinion, to do that is through an annuity contract. But not just any annuity contract, okay? It needs to be one that is designed to give you the most retirement income and also be the safest option as well, okay? So keep in mind when you're putting money into risky investments, and it could be risky to you, and maybe it's not risky to someone else. I mean, all of us have a different risk tolerance. All of us have different feelings about different investments that we would put our money into, because maybe you feel more confident in your ability to manage that. Nothing wrong with that. Okay. I have clients who stay very, very risk adverse, and at the same time, they will put money into annuity contracts to provide that guarantee that they need, but not only for them, but for their loved ones. So if you are someone who provides for your family and you're used to providing for them and you're used to taking care of the investments as well, you might be able to do that and have no problem and never need anything safe to take care of your income needs. But the thing you have to think about as well is, at some point, you're going to pass away, and you might pass away sooner than you think, which you need to ask yourself as well. If that does happen, then what happens to your family? What happens to your loved ones? Will it be harder for them to generate the same income? Okay, will they have the knowledge, or do they have the knowledge to invest in the same way as you? Can they manage it the same way as you? Do they have the same risk tolerance as you? And so most people don't. I mean, most people are like, well, I want to make sure they're taken care of. They don't have the same skills as me. And so because of that, I set up these contracts for them. Okay. And you can set up annuity contracts for you, your spouse, which is what most people do, but you can also set them up for maybe kids that are dependent on you and who will be dependent on you later on. Okay. So again, nothing against risky investments. I love them, but I love them more when I have guarantees. So we're going to be talking about annuities. I'm going to share my screen. I'm going to show you some really good options that you can look at for yourself. You can go to my website as well, johnstevenson.com. You'll see my annuity calculators, which are updated every day. Okay, I've got direct feeds from Canex as well as Annuity Rate Watch. Okay, and so that brings in all the data from all the carriers, and it gives you the information that you're looking for when you're looking for guarantees. Okay, so again, that website is johnstevenson.com. You can also book a call with me there if you'd like, or there's a link below this video where you can actually get on a Zoom call with me and we can talk about your annuity needs. If you're looking for one for your retirement, I'd love to help you. All right, so let's dive in. So I'm going to show my screen, and I've got just a fictional client who's in Colorado. They're 61. They've got $100,000, and I could take this $100,000 and times it by 10. If you got $1 million, just times the income by 10. Okay, so we'll put $100,000 in, and 61 years old. And for this example, it's a single payout. If it's a joint payout, then it'll be a little bit less because the insurance company is on the hook for 2 lives, not just one. All right. So if we were to start income in 5 years at age 66, then you can see that income is roughly $11,000 per year. And that's with Corebridge. Okay. Corebridge, great company, been around for 100 years. Okay. National Western Life is in close second. And then you got Equitrust as well as Athene. And I work with all these carriers. Okay. And there's a place for all of them in every portfolio, or in some portfolios. It just depends on your state, depends on your risk tolerance, and also depends on your assets. And some of these work better for different deferral periods, shorter periods versus longer periods. And so that's why we look at all of these companies, and it's all about you. Okay. It's about when you're going to retire, when you want to retire. And if you might retire early, you might retire late. We look at the best contracts for you so you can have the most growth for your situation. All right. So if I look at this, I say, okay, well, is it risky? Well, again, we're trying to stay out of risky investments, right? Instead of being maybe in stocks or ETFs or even REITs. I mean, depending on what they are, they could be riskier than other options. And so when we look at annuities, people ask, well, what's the risk with an annuity? Well, an annuity is with an insurance carrier. And the risk, of course, is held by the insurance carrier. So what you look at is what is the ranking? Okay, what is the financial status? What's the assets? What's the liabilities? What does that company look like? And so when we look at Corebridge, well, they're A-rated. Okay, they could be B++, which Equitrust is, but I love Equitrust. I'll just tell you right now, they are A-rated by 2 agencies. The only one that has not brought them up to an A is AM Best. And I do feel strongly that they will become an A at some point with AM Best. So they are one of those companies that I really like, and I have put income products with them. Okay, so they're good. Athene is good. They're A+. Okay, Athene has some really good income products. Their growth, not as much, just because the renewal rates aren't so great. But if you're looking for high income, they're really good for that. F&G, North American, and so on. Okay, there's a lot of different options out there. American Equity is great if you defer it out a lot longer. You'll notice that they will get to the top of the list if you do. All right, so if we look at Corebridge, they've been around for a long time, and you have to keep in mind that your premium, depending on your state, is probably insured up to $250,000. Okay, there are some states that are a little bit higher, but most of the states are at that $250,000 level. So if you have more and you want to put in $500,000, you can always divide it up into 2 contracts, or you can put it with a larger company. Maybe you're thinking, well, I'm comfortable putting $500,000 with Athene because they're A+, or with North American. Or if you go down here, you got Midland, you've got Mass Mutual. Mass Mutual is A++, okay? You could always put it in there. You just have to realize the income is less. $96.75 with Mass Mutual versus $10.9. So it's not a huge difference, but it is a difference. So let's bring this, and we'll just change this right now. We'll just say, all right, well, $500,000, what does that look like? We'll just take that and multiply it by 5. That's really what it's gonna do. So, all right, our income is roughly $55,000 a year guaranteed for the rest of our life. So that's pretty good. I mean, you take that out at 66 and you live till 96, you're taking out a whole lot of income. A whole lot of income. That's over $1.5 million from only $500,000. It's pretty good. You bought yourself a pension. It's a lifetime. It never runs out. It's not subject to market risk. Okay, so the market goes up and down. It doesn't matter. So this is an indexed annuity. And when people think index, they're thinking, oh, well, it's tied to an index. It must be risky. No, it's call options. Okay, so what they're doing is they might tie this to the S&P 500, which you can see it is right here. And it's going to grow, but it'll be capped. Okay, they're not going to give you all the growth of the S&P. Okay, there's a cost for protecting your money. And so what they're doing is they are showing you, if we give you only 4% of the growth of the S&P, and that changes all the time, their caps and participation rates change, then we're going to give you a portion of it. And you can see that account balance there go up a little bit, but not much. And then as you start taking income, you'll notice that account value eventually will go down to 0. So, but still, it's an income product. So eventually that account value will be 0, but you bought it for the income. Okay, and that income continues for the rest of your life. That is what that contract is for. It is for income. And by the time you're 95, you've taken out 1.6 and a half. So it's good for income. Okay, and if you wanted to wait with the same contract, you could. Let's say you're like, well, I'll wait another year. Let's just say you reach 66 and you change your mind. You don't want to take income then. Well, you can wait. You can see it's a little bit higher. Now it's like 59,000 almost. So quite a bit, right? So you can wait another 12 months, take more income. You might just say, I'm going to stick around with this job and I just want to be able to lock in more income, kind of like Social Security. You absolutely can do that. And with an income rider, they're flexible. Okay, you can start income now, 3 years, 4 years, 5 years, 10 years, it doesn't matter. If you wait longer, it gives you more. So the difference between that and a SPIA and a DIA is a SPIA and DIA contracts or QLACs, they will basically say, hey, you've got to choose a date. And it is irrevocable. Okay, there are a few that will allow you to kind of move it around, but most of the time it is set. It is irrevocable. There is no cash value. That is it. Okay, with an income rider, you have more flexibility. There's a cash value. Okay, there's just a lot that goes into it, and usually the income is higher. So that's usually why I recommend it, but it's different for everyone. I saw a lot of SPIAs and DIAs for different reasons. So there's good reasons for both. It just depends on what you're looking for in your particular situation. So for instance, SPIAs and DIAs are like period certains. For instance, they would be good for like bridging a gap from, let's say you want to take income from 60 to 67, and then you want to activate income from an income rider at age 67 and on. You can do that. Okay. So people will do that, and it works out really, really well, especially when you work with someone like me who will show you everything that's available. All right. So that's it. What I would say is go to my website, johnstevenson.com, check the annuity calculators there, and see for yourself. See if there is an annuity that gives you the income that you're looking for with what you're looking to invest. And if there is something that you like, then book a call, okay? There is a link below this video, and there's a link on my website, okay? It will go directly to my calendar, and I will get on a Zoom call, and I will show you everything that's available. I'll answer your questions, and I'll help you purchase an annuity if that's what you're looking for. If not, that's fine too. I'm not going to hard pressure sales you to get you into something that you're not ready for. So anyways, hope that helps. Hope this has brought some value. And if it has, hope you like, subscribe, share, and I hope you comment below. And I appreciate you for watching, and we'll see you next time.